Hey, it's Wayne from Visionary Wealth, and this is a good news, bad news, informational, real quick video. We have had a number of clients as they're working through their taxes, traditionally or typically folks who have larger non-retirement accounts. We're getting some surprises in terms of the amount of capital gains recognition that we have from last year, and I thought it would be appropriate to maybe just give you a little bit of an information on it and kind of why that happened. So if you think about the last couple of years, 2 years ago now, in fact 2 years ago this past week, we were going into COVID shutdowns right around March 15th of 2020. The market was crashing. The market ultimately went down about 38% in 6 weeks, and at that point, right at that 38% down point, I sent out a video to you that said that we had taken about a third of all of your safe or more conservative investments and moved them into the market. And at that time, we didn't know if it was the bottom of the market, but we said that this was a first tranche, and if things continued to deteriorate, we would buy more. Well, things didn't deteriorate further from a market standpoint. From a COVID perspective, they sure did. But from a market perspective, the market kind of bottomed there in late March when we were buying and then began to rebound. Well, the opposite scenario played out last fall. In September, October timeframe, I sent out a video to you to let you know that we had taken the opposite step. We had moved 15 to 20% of all of the equity positions out to one-year T-bills or more conservative positioning within your portfolio. And we've been kind of sitting, waiting to redeploy some of that capital, and we're just starting to do some of that now. But recall that we bought low in 2020, in March, April timeframe of 2020. We sold much higher in late 2021. Now, these are all long-term capital gains. These aren't short-term capital gains. We're not trying to day trade the market or anything. But if you have a sizable non-retirement account, the sales that we pulled off in September, October timeframe of 2021 did trigger some excess or some higher than normal capital gains recognition in your non-retirement account. So if you're having those conversations with your CPA, with your tax person, and that's raising some questions in your head, that's why this happened. Now, our position always is let the asset that has created the tax liability pay for the tax liability. So if you're running a little cash poor on the home front and you need to write a check, please don't feel like you need to stress yourself out. The money that you made is in the accounts and it's available to pay the taxes. So I just wanted to let you know that that's kind of what's triggered maybe some higher than typical capital gain recognition in 2021 that we're now having to take care of in 2022 as we file taxes. If you have any questions on this or anything else at all times, please feel free to give us a call. We're always here with perspective for the decisions ahead and perspective on the decisions that have already taken place. Hope you're having a great day and a great week. Bring on spring and bring on summer 22. Have a great day. Take care.